If you're running a 5 to 10 engineering team and you've assumed that the R&D tax credit is for bigger companies, you might be sitting on a six-figure number you didn't even know about. I've spent 8 years on this and I've watched a 17 engineer team unlock about $187,000 in payroll tax offset they almost walked away from. So by the end of this video, you'll probably know whether you are a probable yes, a probable no, or worth looking into, all before you book a single call. So here's the pattern that I see almost every single week. A founder takes one look at their 5 or 6 person development team and thinks, look, we're just not doing research and we're just shipping basic features. And that one assumption ends up costing them 6 figures over the first 3 years. The reason it costs them is very, very simple. They're applying their own methodology and their own definition of what research and development actually is. So they're not applying what the IRS definition of what research and development is. They are thinking to themselves, and look, we're not doing research and it's something that wouldn't qualify. What your definition and what the IRS's definition of what R&D is two completely different things. So when you think of research and development or R&D, you probably picture someone, say like in a lab coat, or someone doing very technical work, or they're building some fusion reactor, right? So the IRS doesn't see it that way though. They have a very specific test which defines what they call qualified R&D, and it's really called the 4-part test. And that test really decides whether your work qualifies under the definition of R&D that the IRS has put out there. So once you run your actual work through this test, the picture often flips. And let me walk you through that test right now. What is the 4-part test? Well, it's an AND test, and part 1 is going to be the permitted purpose test. Now, really, in plain English, this just means why are you building something, right? If you're building something new, or maybe you're making something existing better, faster, more reliable, more frequent, or at a higher performance. So think about it. If you have a 7-person engineering team and you're making a brand new feature, and this is a feature that the customers haven't seen before and you developed. Think about that. This passes that first part of the test. You're building something new, or you're building a feature on top of your platform. Now, what doesn't qualify is, say you're just redesigning your marketing site to look prettier, or you're changing the colors on a button. That fails the test. So part 2 is technological in nature, or basically the hard science test. The IRS only counts work or projects when it's based in a hard science. Think of math, engineering, biology, chemistry, computer science. These are the more formal and natural sciences. If you're doing software development, that counts. But say, for example, you're designing a new UI purely for look and feel and better usability, those things typically don't count. So we've done 2. Now here's the 3rd part of the test. The 3rd part of the test is going to be technical uncertainty. So what does this mean? This means that the IRS wants to see that there were technical challenges throughout the development process. And this is the one that most founders get wrong all the time. The IRS doesn't want a straight line between the blueprint and the final result, right? They want to see that during the process or during the work that you really had to approach it in a different way. Let's walk through an example together. So you're trying to get an analytics query to return under 1 second, and you're trying to do this at scale. You didn't know really how to approach this. Maybe you use an index strategy, maybe you use streaming aggregates, maybe you tried 1 or 2 approaches that didn't really hit the mark you were looking for. So that's what we're talking about right there, and that is what the IRS wants to see. Okay, now we're on part 4. Part 4 is process of experimentation. Now, how did you resolve the uncertainties that we just talked about in part 3? Did you try option A and then, no, that just failed? Maybe you built a prototype or ran an A/B test, or you threw out an old design that didn't work. So all of those things count, and all of those things show that you had a process of experimentation and essentially the scientific approach of trial and error. To recap, permitted purpose, technological in nature, technical uncertainty, and then process of experimentation. Those are the 4 parts of the test. Now, here is where small teams often get surprised. Now, remember, this is a AND test. All 4 parts of the test need to be met in order to qualify. Look, once you start applying it, and honestly, most of your normal engineering team work will clear this 4 part of the test, especially if you're developing new features or new functionalities. Say a 7-person engineering team is shipping and building new features, and during this process they're hitting obstacles, they are trying new things, and they're maybe getting rid of the things that don't work. This is textbook profile for what the credit was made for. If I were you, here's what I would do tomorrow. I would take the top 5 projects your engineering team is working on or built this year, and for each one, I would write a simple 2-sentence overview. What were you trying to build? Why were you trying to build it? Is it for a reason of making it better, maybe faster, bigger performance, better quality? And then what were the things that you were trying to figure out and you had to prove through experimentation? Now, say 3 of those 5 projects clear all of the parts of the test. Then you know exactly which projects qualify and which ones don't. Now you know exactly who the credit was written for. You can run that 5-project audit yourself, and of course that's a legit path and you should be doing that anyways. But if you would rather have me look at it with you and go through it together, the free 25-minute snapshot is in the description below, so you can go ahead and click that and I'll walk through it with you. But for now, let's get back to the diagnostic. Okay, now let's say you've run your work through the 4-part test and a few projects clearly meet the criteria. The question becomes, how big does this actually get? Most founders dramatically underestimate how much credit they could potentially claim. What they do is they count their core engineering teams and multiply that to do the calculation, and basically they stop there. This is where the second framework I want to introduce comes in. So I call it the 3 layers of qualification. Once you see your team through this specific lens, the credit is going to make a little bit more sense, and typically the math doubles. Layer 1 is going to be direct research and development. So this is exactly what you think it is. This is the core engineering team that is doing the hands-on development work. Think about from conceptualization to architecture, design, implementation, QA, and testing. These are the folks that are in it every single day, all day. Say if you have 6 engineers and those are heads down product development folks, this is roughly maybe 70 to 85% of their time. This is qualified. So now most founders and folks thinks R&D stops there, but no, there is more. Let's look at layer 2. Now, layer 2 is going to be direct supervision, the first line of management that is overseeing the direct R&D work. Think in a small 7-person startup. These supervising folks are often your CTO and maybe your technical founders, right? Their time is spent reviewing code, they're sitting in architecture sessions, they are deciding which approach to ship, they are deciding what are the requirements and which approach to take. All of that time doing that work is qualified. Now, let's pause. Not all of their time is qualified, because obviously there's budgeting, selling, resource management. All of these activities don't qualify. But the supervision of the actual development work does qualify. And clearly, in the early stages of your company, supervision work can land. Typically, we see maybe 20 to 30% of total qualified payroll. Now we've got layer 1 and layer 2. Let's look at layer 3. Layer 3 is support. This is where it gets kind of interesting for smaller teams. The IRS actually gives real examples of what qualified support is. They talk about an admin assistant sitting in a technical meeting taking notes, and they say this work is qualified. Think about that. This could be an admin assistant like they mentioned, or maybe it's a salesperson gathering business requirements directly from the customers. Maybe it's your administrative team helping out with QA on the new release. Oftentimes in a startup, this happens all the time. You have folks wearing multiple hats and helping out in different areas all the time. Maybe your sales lead is on a customer call feeding requirements directly to the engineering team. Maybe your operations management is testing the pre-release build. All of that time, again, just that time related to those activities, those would qualify for R&D work. Let's walk through a real example. So we picked up a space tech client that has been using a cookie cutter provider before they worked with us. Those providers found less than $500,000 of qualified wages, which produced about a $50,000 credit. But when we actually looked at the work and we mapped the team utilizing this framework and the 3 layers, we found roughly 1.5 million in qualified wages. So that's around $150,000 in actual credit. Think about that. It's the same company, the same expenses, but it's $1 million in qualified spend that they were told didn't count. The COO told me afterwards it was the first time they had actually understood the process. And look, quick disclaimer here, every situation is going to be different. And your specific situation and your numbers, it depends on what your fact pattern is. I want to emphasize here, this framework stays the same, but the fact patterns could change depending on your own situation. Okay, now drop a comment with your team size if your CPA has ever raised R&D credits with you in the past. I'm genuinely curious how common the gap is in this audience. Well, what does this mean for you? Before you decide whether this credit is worth pursuing, you map your team to all three layers, not just the engineers, and the number you've been mentally calculating is probably half of what the actual credit could be. So that gap in, say, a 7-person engineering team is often a big difference between not worth my time and an obvious, yes, this is something we should be doing all along. Quick aside, that space tech company we worked with, they jumped from 50K in credit to 150. This isn't just a one-off. It's a pattern that we see often when teams get screened against all three layers instead of just one. So you can run the layer mapping yourself and you can grab a free snapshot call. The link is in the description below, so please go ahead and use that. But for now, let's get back to it. Now let's look at a couple different things. One area I want to bring up because this does change the math and how you pay your engineers. And those two things are W-2, so think a engineer that's on payroll versus a 1099 contractor, so a contractor that you would pay with a 1099. I want to walk through the math a little bit here, so let's go through an example. So for example, I have two identical engineers. They are working on the same thing and they're both paid $150,000 a year. One engineer is a W-2 employee of the company doing 85% qualified work. Now, if you are qualified at 80% or higher, there is a rule called the substantially all rule, which the IRS allows you to capture all of that work at 100%. So essentially, the full $150,000 lands in the calculation. Now let's look at the contractor. So the IRS automatically says that if you're a contractor doing qualified work, there needs to be a haircut of 35% on the contractor costs. And then also you don't get the substantially all rule applied to contractors. Now let's look quickly at the math. From 150,000, you now start at 127,500. So being qualified at 85% minus the 35%, so actually you end up at around 83,000 of qualified expenditures. These are two examples. One example, full 150,000. The second one, only 83,000. Two identical individuals being paid the same, but you get 45% less credit. If you're hiring US-based engineers and you're choosing between, say, an employee and a 1099 contractor, the credit math is just one input that favors the employee. So most founders don't have this on their list when they're making hiring decisions, but now it's just something that you can have in the back of your head to take into consideration when you're choosing what your team wants to look like. Now let's get into the actual diagnostic. The way that most teams self-screen is just by feel. And the two areas that they get wrong most often is one, they self-disqualify when they really shouldn't. So they think they're not doing qualified work, but they actually are. Now, the second one I want to talk about a little bit further, and this is an area where they think they're doing qualified work, but there's a clear disqualifier in their fact pattern that I want to talk through. There's three places where small teams genuinely don't qualify. Knowing this ahead of time and upfront can really help the entire conversation, and it will help you guide through this process much quicker. So the first disqualifier, your engineering team is mostly offshore. The IRS only cares about work being physically done in the United States. So if 80% of your engineers sit in, say, Poland or India, you can write that beautiful R&D write-up, and guess what? It's not going to matter because the underlying expenses are foreign. So if you have onshore plans later, maybe for next year, and you're expanding the team, that could change the conversation, but for today, it's going to be a pass. Now, second disqualifier, and this one catches dev shops by surprise. It's the risk and rights test. A couple checks that you need to work through. Say you're a dev shop and you're doing work for a client. You need to do the first check. Who funded the work? If a customer paid you to build something specifically for them and they own it completely, that is their R&D. That's not yours. So they can claim the expenses related to that, but not you. If you think about it, they're the one really taking the risks. So therefore, they're the ones that get to claim the expenses related to the research and development. Now, check 2. Who owns the resulting code? If the IP transfers to your client, that is another signal that the credit follows to your client, not you. If you are in, say, a 7 to 10 engineering shop where every product is contracted out and every line of code transfers to the client, that's a signal that the entire credit goes to your client, not you. For example, we've had $1 million engineering teams ultimately disqualify based on these tests alone. They didn't have the rights to the work and they didn't have any risk in the work that they were taking as well. A third disqualifier that I want to talk through. This is when you are truly too early in your business life cycle to qualify. So think solo entrepreneurs or a small founding team. You don't have any employees, you don't have any engineering payroll yet, and there's no real expenses to drive the credit. Simply set a reminder for next year, and once you hire 2 or 3 engineering teams and you start getting those qualified costs, that is when you want to check back in and see if you qualify. If you don't fall into any of these 3 buckets, here is how you triage yourself today. The first triage is going to be a probable yes. You probably have R&D. You have at least 3 to 5 US-based W-2 engineers. You have real technical uncertainty across a few projects. Or you have US engineering payroll above, say, $200,000. The math almost always justifies a serious pursuit of the credit, especially if you sit in states, say, like California, Arizona, Georgia, Massachusetts, Texas. These states provide an additional state-level credit that stacks on top of your federal credit as well. Okay, now the second triage. Maybe this is worth a deeper look. Say, for example, you have 2 to 3 engineers, you have a mix of W-2 and US-based contractors, and your payroll is under 200 grand. If you think about this, run a back of the envelope calculation and see what 70% of your qualified expenses will come out to be. Now, if that number breaks, say, 20K and you're in your first 5 years of inception, it's definitely worth looking into whether the payroll tax offset makes it worth your time. Okay, now the last triage. Probably no. This is when you have your team that is mostly offshore, or you're a contract for hire doing work specifically for a company and your client owns the IP. And maybe you're still pre-payroll and you just have a small founding team. If that's the case, again, as I mentioned before, set a reminder to revisit in 6 months when your fact pattern changes. Here's where I land if I were you. So if you scored a probable yes, it's definitely worth a deeper dive. Get the answer instead of just guessing on your own. Run the math yourself first, or what you can do is you can grab a quick 25-minute snapshot call in the link in the description below. You'll know inside 25 minutes whether this is a real benefit for you or not. So here's where I want to leave you. The R&D tax credit isn't for the company you'll be in 5 years. It's for the work that you're already doing right now. The 4-part test, the 3 layers of qualification, the contractor math, the risk and rights determination, all of those, they aren't gatekeeping rules to keep you from the credit. Rather, they are a new lens in which you can turn a team of, say, 7 engineers into a 6-figure credit year after year. There are 2 paths from here. So take what I just walked through and run the audit yourself, do a calc to make sure to see if you qualify. That's a great thing to do and you should be doing that anyways. Or if you rather have it do it together, you can click the button below in the description for your own snapshot and we can talk through your specific scenario. Quick note before we wrap up. Everything I covered today is educational content only. How the R&D credit generally works, all of these things, every company situation is going to be very, very different. And the exact math and the credit amounts are going to depend on your specific fact pattern. This isn't individual tax advice for your own company. Please check specifically with your tax advisor on your specific scenario. Thank you, and I'll see you in the next one.